Hello and welcome to the latest webinar from the University of Oxford Said Business School. Today we're focusing on private equity, and this webinar is in support of our executive education program in private equity. Today we have Professor Tim Jenkinson, who is a professor of finance and has been researching and teaching in private equity for a decade and more, in conversation with Chris Kallos, who is a corporate partner at Kirkland Ellis, based out of Chicago and New York. The conversation will take us about 40 minutes or so, we're planning. We would very much welcome your questions as we go through. So please, there is a question panel in front of you. If you have any questions at any time, please enter your questions into there, and we will try to address those either as we go through or in a Q&A section at the end. So please, questions into the question panel in front of you. We have almost 100 people online, so we have all attendees on mute just for background noise. So that question panel is the best way to communicate with us, or also there's a chat panel for any general comments as well. So thank you very much for joining us today. With that, I'll hand over to Professor Tim Jenkinson for a look into private equity's roaring 20s, a peek into the future.
Right, well, thanks very much, Steve. And we came up with this title a few weeks ago, and obviously there is a sense in which maybe the 20s are less roaring than they were 3 weeks ago. But I wanted to start off without, spending we'll look into the future in a minute, but I thought I'd start off by asking Chris, what has the last year or so shown in terms of the environment, the amount of deals that private equity funds are doing, and before we go on to, what the current situation is, or what the effect of current economic turbulence might be on the private equity market. But how's it looked over the last year, Chris?
So I would say over the last year, it's continued to be a relatively robust fundraising environment. Sponsors are going back, raising larger funds. It's not uncommon for people to be looking to raise something like 1.5 times their prior fund. And they're getting the funds closed. The market for kind of terms has also continued to be kind of where it was. So folks that have a deal-by-deal carry distribution waterfall and American-style waterfall have kept it, whether they're U.S. sponsors or even European sponsors. If they had an American-style waterfall, we haven't really seen that eroding. And the alignment of interest has been achieved as it was in the last couple of years through, usually more than one interim clawback to make sure that there's not a long delay for LPs to get caught up if there's been an overdistribution of carry. And the waterfalls also tend to require a larger than maybe it was years ago percentage of funded expenses to be returned in the waterfall as you go along if you have an American-style waterfall. For a while, people were predicting lots of escrows of carried interest, and that really hasn't taken hold all that much, or they're still relatively uncommon. And that's understandable given the inefficiency of holding cash at, what's basically a zero or in some places negative interest rate environment. Fees have remained kind of resilient within size bands. So there's been some recent press about there being increasing fee pressure. I think a fair amount of that is really the result of funds getting larger, and as they get larger and into the next band of fund size, those fees tend to drop. So I think a lot of the fee pressure is really, if you had a 2% fee and your latest fund is going to be $3 billion, it's pretty hard to keep that 2% fee. So as funds get above $1.5 billion, $2 billion, it's relatively hard to keep a 2% fee, and by the time they're at $2-3 billion, you're seeing fees in the kind of 1.5 to 1.75% range as a headline fee. Interestingly, though, when those same sponsors launch a new product, a new $500 million fund, fund one of a new product line, they tend to go for and get a 2% fee again. So there's always attention to fees, but I'm not seeing a lot of fee pressure. Carry remains kind of as it was, basically 20% with some premium carry and a few discounted carry, but not a lot of examples of lower than 20% carry for buyout and growth equity funds. There are other products that tend to have different economics. And then early bird discounts haven't caught on, I think, as much as people thought they would. A lot of it is size-based, et cetera. So things continue to be good, I guess, is the summary, and not all that different than they were a year or two ago in terms of the basic terms and the health and robustness of the market.
Yeah. Now, my impression from going and talking at a few of the industry conferences is that I can't really remember a time when institutional investors were clamoring for private equity so much, actually. I mean, I remember being at one conference and saying, okay, who's aiming to increase their allocation? Virtually every hand in the room went up. And I suppose that's potentially worrying when you see everybody going in the same direction. But certainly, I suppose that if your message is really that the economic terms of these funds isn't really changing very much, except for scale effects, that's really because there's an awful lot of demand from LPs for funds at the moment. Is that right?
Yeah, I think that's right. There's also, and we'll talk a little bit more about it later, a lot of new products coming on from existing sponsors. And so I think some of the leverage that they might have from there being so much interest in coming back to the better performing funds is getting used to get some new product lines launched. And that is also facilitated by and kind of requiring larger GP commitments, or at least in the aggregate, sponsors are needing to come up with more capital so that they can put the requisite amount into new products while they continue to support and expand their commitments to existing products. One thing that I guess kind of dovetails with what you were saying that I guess I would be interested in, because I know you're probably closer to the research than I am. There is this new Bain report with a headline. I'm not sure how accurate the headline is when you look at all the detail in the report, but the headline is basically, for the first time, private equity is not beating the public markets. I know you've looked at that and can maybe give us a little bit more about that, but I thought that was interesting, but I suspect not as I think the devil's in the details, but maybe you can tell us what you think of that.
Yeah. Well, yeah, that's indeed one of my specialist subjects. And I think, you can present data on returns in many different ways. And I start off with the sort of standard way of doing it, which is to look at vintage year returns. So in other words, how did the 2005 vintage year funds do ultimately? Or how well did the 2010 vintage year funds do, even though they're nearly at the end of their life, but they're not quite at the end of their life? And if you were just to look at those on a vintage year basis, and I'm focusing here really on buyout funds, not so much on venture capital, which is a very different and a very interesting story. But if you look at buyout funds, there's no doubt that there was a period over which the returns on those funds came down pretty steadily relative to public market returns. So specifically, between about 2000 and about 2008, the returns, the premium on those funds over public markets definitely came down. And indeed, if you look in like the nadir of the buyout market, really was around the 2006, 7, 8 funds, just the ones before the financial crisis, which got invested a bit before the financial crisis and then were exiting before the real uptick of returns. And for some of those funds, you can find against certain indices, they may have performed slightly less well than public markets. So in particular, the S&P 500 has been a hard taskmaster over the last 10 years, for example, because large cap US stocks have done extremely well. And the last time I looked, some of those 6, 7, 8 vintage year funds were sort of around about the public equity returns. In other words, you would have done pretty much as well having your money in the public market as you did in the private equity fund market. However, they are the exception rather than the rule. Every other vintage year has actually performed better or is projected to perform better than public market returns. And indeed, most other indices against which you compare private equity actually suggest that private equities perform better. So if you used arguably the more sensible like Russell 2000 index, then the private equities outperformed public markets, I think, in every vintage year in the US. So that's not the way that the Bain report does it, though. The Bain report does it over different investment horizons across vintage years. And in a way, what I've just said is sort of consistent with their results, which is that, if you look back 10 years from 2019, you get to 2009. And 2009 was not a good period to be in the private equity market. And so the 10-year return has not, on their basis, just is about the same, just slightly below public markets. But the 1 year, 3 year, 5 year returns are better than public markets. And my strong suspicion is the next 10-year return that they do, if they do the same analysis in 2021, will also be better than public markets. So I think it's quite a selected result, I suppose is the way I'd put it, because by most other ways of measuring returns, private equity has pretty consistently beaten public markets. And certainly that's the results for the US. It's even more so the case for Europe. And in fact, the Bain report says that the European returns have consistently beaten public markets. So yeah, I think the headline might have led you down to a conclusion which isn't really backed up by the long-term evidence.
Interesting. Okay, I mean, in terms of other things that we're seeing that I think are maybe new or expanding, one of the things on our list is the fund level finance or just financing generally.
Yeah,
we've seen a movement over time. Originally there were uncommitted lines, then there were committed lines at the fund level, with that leverage being available to also support loans to portfolio companies that are guaranteed by the funds. And for a long time, people would tell me that that's the only kind of financing that's really going to be available to funds. No banks are going to lend except against uncalled commitments, which I never really understood or agreed with. And now it does turn out that that's not true, and there are an increasing number of lenders offering a variety of financing at the fund level. So you have these unlevered assets at the fund level, meaning the equity holdings in the portfolio companies that are held at the fund. Traditionally for private equity, unlike hedge, were essentially unlevered. The only kind of leverage that really existed there were advances against uncalled commitments. Now we're seeing some more movement in that. The term of outstanding subscription lines or leverage generally is getting extended. It used to be kind of 90 days or less. Now you're seeing 6 months, a year, in some cases 18 to 24 months, with roughly, according to a recent survey, half of the leverage, the lines at the fund level being 12-month lines. So that's a change. The percentage that the funds are allowed to borrow has also been increasing. But I think more interesting than all of that, that's all on the existing kind of subscription lines that we've had for some time, and that now most sponsors are using. You're seeing people willing to loan against the assets at the fund level, so not the uncalled commitments, but the investments that are made. And so I think that's interesting. It seems like unencumbered assets kind of attract leverage, particularly in low interest rate environments. And people look, and lenders of various kinds are structuring products to get leverage into these places where it wasn't really so available before. So we're seeing it at the fund level. We're also seeing it at the sponsor level, kind of helping those sponsors increase the commitments that they can make by providing some leverage to them.
Yeah, can we split those two things up, because I think they're both really interesting. And for those people who might be getting into the weeds of a private equity fund, but essentially what's happening, the first type of leverage Chris is talking about there is where essentially you make a commitment to send money to the fund when they find an investment, but the fund can say, actually, you don't need to send us the money for a while because we can borrow the money against your commitment. You've told us you will send us the money, but we can go to a bank and they will lend us the money for a while, so we don't actually have to call it from you. And the effect of that, of course, is when you're looking at the returns that these funds are creating, certainly when you're looking at like the IRR, the internal rate of return of these investments, it can go shooting up because in fact you don't really have your money invested for very long, because for a while, for a year or maybe a bit less, the money is actually being used to buy the company is coming from a bank. And certainly in the academic world, this is being thought of as just in a way to soup up IRRs that are measured, which is just a sort of race to the bottom, that it doesn't have much rationale from the point of view of the investor, but if everybody else is doing it, if you're pushing up your IRR by not calling the money so early, then I have to do it as well. And so I don't know, that's probably a cynical academic view, but is that a view that you share or that other people in the industry sort of articulate?
Well, I mean, the banks came out with these products years ago, and they said to the sponsors, you should get one of these, everyone's getting one. And at the time, that was untrue, but it became sort of self-fulfilling for the reason that you described. Everyone's getting compared, and people want to be in the top quartile funds. And if other people are using leverage and goosing their IRRs, and that's not the only way people measure quartiles, this has a significant effect, or can have a significant effect on IRRs. It really doesn't do much for multiples. It actually can erode multiples a bit because you have this expense. But because it's goosing IRRs, I think people have gravitated towards not just having them, but using them more.
Right.
And so that's kind of leveling out the playing field in terms of being able to evaluate and compare sponsors on IRR, because now people are generally using it, but people who have more availability and are using it more can get more benefit. It also has, and this is probably too far in the weeds, it has the effect of making it easier to achieve the preferred return. And so some LPs have complained about that, but you got to take that in balance with the fact that the preferred return was 8% when interest rates were at 5 or 6%, and the preferred returns at 8% when interest rates are at 0. So I guess I'm a little bit sympathetic to concerns about the fact that it's making it easier to achieve the preferred return, but maybe it should be. Maybe the preferred return should really be moving down, although it hasn't.
Yeah. And the second type of leverage, which I think may be the one that people know even less about, is the idea that you can take some of the assets of the fund and borrow money against them. And I know that sometimes these are, in a way, there's a whole class of transactions which run from secondary transactions where you actually sell your stake in the company, or the LP sells the stake. But it can also be putting debt into the fund, right? And actually, presumably, that debt then goes back to the GPs use that debt to give LPs an early realization of their investments. Is that right? Could you just give us a bit of a sense as to how that type of leverage actually works?
Right. So this is a leverage that everyone said wouldn't be available. And now is. I think it'll be used actually pretty extensively in the coming years if the low oil prices and the virus crisis continue for some period, because I think a lot of portfolio companies are going to need support, and they're going to want to get that support ideally from the funds that have invested in the portfolio company rather than maybe the most recent fund. And one way to get capital in these funds that or funds in these monies to support the portfolio companies is through leveraging up the assets at the fund. And so I think we will see a fair amount of activity in this. It doesn't have to even be debt. It could even be equity at the fund level, like a preferred. But a number of providers have emerged to make this capital available. It'll enable folks to support the portfolio companies. I think you're going to see it there much more than just borrowing money to get returns to LPs.
Right.
But in theory, you could see it for that as well.
Yeah. And now we said that's in the sense the state of the market at the moment. When people are thinking about the mayhem that's going on in the markets the last couple of weeks, I thought it would be good just to sort of stick to our brief a bit and talk about the roaring 20s, or at least the 20s. And I suppose my view on this would be, like, we have record amounts of dry powder out there. The fundraising environment that we've been talking about for the last couple of years has been so robust that there's several billion dollars of money for buyout funds and a few $100 billion of money for venture capital funds, which has been raised or been committed by investors but has not yet been invested. So in a way, they're sitting on the available investable money at the moment. And do you think that ultimately, whilst this clearly isn't great exiting your investments if the market's been going down, do you think this also creates the sort of opportunity some of the private equity funds have been waiting for the valuations to come down off their peaks, and maybe there being a bit of a liquidity crunch, or some distressed companies arising from this? Is this actually the time when you'd expect to see quite a lot of private equity activity?
It's a little early to tell. I think some folks may move to kind of a risk-off mentality for a while, but I think that will relatively quickly turn into people, evaluating opportunities. We're already seeing that in credit funds. There are some credit funds who are sort of taking a wait-and-see approach and kind of risk off for the time being. But there are other credit funds who are pretty excited about the fact that there will be real opportunities for them to get capital to work as this dislocation causes a lot of companies to need capital. And so I think like any situation, there's going to be, the dislocation will create opportunities for folks. I think it will also cause some sellers who might have thought, hey, let's build this company for a couple more years before we go to sell. I mean, if this becomes it's very unclear now. By the time people listen to recordings of this, we'll know a lot more about how things played out. But right now, sitting here, it's pretty unclear what exactly we're in for. But if it is a prolonged dislocation, or if people are concerned that it may be a prolonged dislocation, particularly with some of these older funds that may be in year 10, 11, 12, and may be under a lot of pressure to exit their investments and not have them held into year 15 and 16, I think there may be some capitulation and sales despite the weak market.
Yeah. No, it'd be interesting to see how this all works out. I agree. Can we just shift gear a little bit, because the other big trend that we've noted in a couple of the conversations we've had in the past has been the growth of co-investments, which we've discussed a bit as being a way in which LPs can reduce the cost of their private equity exposure. And again, one of those sorts of things that I pick up at every conference that I go to is that every LP I speak to wants to do more co-investment. And I guess that this is partly, again, down to the state of the market as to whether GPs need to offer significant amounts of co-investment. But what are you seeing from the practice side in terms of, the demand for co-investment, the terms of it, how much funds are likely to allocate in their,
Sure. I think there's some tension and a variety of things that are going on. So, yes, lots of people want to do co-investments. I think the increase in dry powder and the increase in fund size, on the one hand, reduces the need for sponsors in many cases to get co-investment capital in order to get their deals done. But LPs do like them, and I think sponsors continue to use it as a sweetener for early closers and new funds, and use it to keep control of more of the company or the round if it's a growth equity fund, or to avoid having other private equity sponsors in a deal. They'll offer co-investments to their LPs. So it's still out there. I think we're seeing it I think there's two interesting things that are kind of on the newer side for it. One is increasingly we're seeing co-investments offered as part of liquidity solutions for aging funds that have a portfolio company or two left in an older fund. But there's some attractive things about hanging on to that investment. Maybe it still has quite a ways to run. Maybe it's depressed and people think it'll bounce back, or maybe it's not a rocket ship investment anymore, but it's a kind of nice asset to hold. Maybe it's going to return 10, 11, 12%, not 15, 18, 20%. In all those situations, sponsors are increasingly looking to raise a special purpose vehicle to buy that asset, or maybe even two assets or three assets in a more structured secondary transaction, but let's just say one asset from the old portfolio, allowing investors to roll and bringing in new capital to hold that investment and maybe continue to fund growth in that investment through add-on acquisitions, et cetera. So that kind of co-investment we're seeing more and more of. That and some of the other co-investments we're seeing have economics for the sponsor. So the idea that LPs like co-investments because it drives down their cost of being in private equity because they're traditionally no fee and no carry, I think that's still alive. There's still lots of no fee, no carry co-investments, but there are more and more co-investments that have some level of fee and or carry to them. So I think that's but those two things, that the use of liquidity solutions and the increasing incidence of there being fee and or carry on co-investments are a newer item that we're seeing.
Yeah, no, I think that's right. I mean, it's interesting, isn't it? I've certainly seen some people say that co-investment is also sometimes a function of how good your last fund was. That some of the weaker funds have to offer more co-investment to the LPs to entice them into the next fund. Is that something you see, or is that just a myth?
Yeah, there's some of that. I think, as I mentioned, it's in some cases a sweetener for early closers. I think there are a decent number of sponsors out there that are kind of good long-term stewards of capital, but are not hitting the kind of returns that some of the other funds are hitting. So they might, they haven't been necessarily regularly recurring top quartile funds, but they're still kind of good funds. And I think part of the way that they operate their business in some cases is that they will make a larger GP commitment, and that will help assure the LPs that they're shoulder to shoulder with the LPs on the downside. So it's both a demonstration of confidence in their business, but also a greater alignment. And then offering co-investments to LPs, et cetera, that maybe have either a reduced fee and carry or maybe no fee and carry as a way of kind of getting some, at least for some of the larger investors, lowering their cost of being in the fund without affecting the headline rate.
Right. Yeah. The other thing that I keep seeing, which is again on the conference circuit, is the growth of the private credit side as well. I realize that we mainly talk about private equity here, but you see a lot of the private equity funds also, or traditional private equity GPs, who are now offering multi-product offerings, and very often they seem to be moving more into the credit space. And I've often wondered about that in terms of conflicts of interest, how they handle that whether investors think that the brand does stretch into other, adjacent areas, because clearly there are there are specialist private credit people out there, and it's rather a different sort of skill set, I would say. So what are your thoughts? Are you seeing a continued growth of these multi-product sort of GPs who are stretching their brand into other areas, and are LPs amenable to them?
In a word, mostly yes. Maybe that's two words, but I think often the second fund product line that sponsors in the buyout or growth equity space launch is often a credit fund. Usually it's either the credit fund or as their flagship fund moves up market in terms of fund size, a more kind of smaller cap focused fund, which they have a different name than their flagship, that focuses on maybe the work that they used to do in kind of the next tier down in terms of deal sizes. So those are the two most common, I would say, new product lines to launch. I think it's an underappreciated fact that credit is both a much larger market and a much faster to scale market. And I think people are discovering that, and that's part of the appeal. A lot of these things fit together, but part of the appeal of launching a credit fund is it can help you scale your business quickly because you can deploy the money there's just much more credit out there than there is equity. And so you can scale your business more quickly. You can slice and dice the credit into different kinds of credit funds and have multiple credit funds. You're right, there are very much high quality, top of class kind of credit focused sponsors. In other words, private equity sponsors where their flagship products are credit products. But the market is still accepting of others moving into that space, often hiring a new team. But I think the market accepts that the deal flow, the deals that they're seeing, whether they do them in the equity fund or get outbid in the equity fund or don't like it as an equity deal, that deal flow can help support a credit team. So that's resonating. In some cases, the credit fund is focused on an industry that the sponsor has lots of success in. So industry-focused sponsors sometimes launch credit funds also focused on the industry. In terms of conflicts, a lot of these funds specifically don't do investments in the portfolio companies that are also portfolio companies of the equity fund of that sponsor. Others are specifically targeted to mostly invest in the portfolio companies of the sponsor. There are usually a set of rules that you can come up with that help maybe outline which of those kinds of investments that might otherwise present conflicts can be done without going to the advisory board for specific approval. For example, if it is a equity fund investment and your credit fund wants to come into the credit, it can be helpful from the credit fund's perspective if there are other folks coming into that credit. That can make it clear that the credit fund's not kind of overpaying for that. On the equity side, it might be helpful if there are other equity holders of the company. So there are a bunch of factors that might give the sponsor room to operate without seeking consent. Other sponsors, again, don't do those cross-fund investments, and that's how they deal with the conflict. So there are solutions to the conflicts that are presented.
Yeah, and one final question on that one. Do you find some private equity sponsors who don't want to take credit from the credit arm of one of their competitors? Because whether that's giving them some sort of insight into what they're doing, or they're thinking, okay, when we come to exit this, they're going to know more about this investment than somebody else, or do they trust the Chinese walls that I guess have to exist between the credit and the equity side? It's funny how over time, the private equity funds seem to get more and more like old-fashioned investment banks, in my view, that they start facing the same conflicts that they were designed to, in some ways, to avoid.
Yeah, I think we'll see how that develops, because I think we're still in the early days of lots of buyout fund sponsors launching credit funds, and there's so many credit sources out there that I haven't at least heard of that as a significant concern, but it may become one as more and more of the competitors on the buyout side have their own credit funds. I think what I'm seeing what I see people talking about more is, we got outbid on the equity, but we like the company, and it's okay if they're overpaying for the equity. We can still make money on the credit, and so
Right.
there is some of that going on. I think the other thing that's interesting is that, and I think we probably should talk a little bit about minority stake investments in private equity funds. The credit piece of it is really attractive to the investors in the sponsors. So these funds and other investors that exist to invest in private equity sponsors as opposed to private equity funds, lots of them really like the credit business and the fee stream that comes out of that. And so that can get high cap rates and nice pricing. And so that's another reason that is cited for why people might be launching credit funds. And it's a kind of, if you think of it as virtuous as I do, a virtuous cycle with the minority stake investments, that more credit funds make it more attractive for minority stake investments. The minority stake investments, if they come in as a primary, meaning that it goes onto the balance sheet of the sponsor can then use that balance sheet money to both increase their commitments to their flagship funds, but launch new funds like credit funds or other product lines. So it kind of they feed each other a bit.
Right. Now, on our brief, we had a couple of other topics, which maybe we'll just touch on very briefly in the last 3 or 4 minutes. We thought that specialty funds, could be something which is something which is interesting market development, sort of including the sort of new versions of corporate venture capital funds. Can you give us a bit of an insight into what's happening there?
Sure. I mean, people are continuing to differentiate themselves by having more and more focused funds. So that's happened for a while, and it happens across geographies and industries and themes or strategies. I think maybe we should explain what I mean by corporate VC 2.0. Corporate VC is a challenging thing to do. It's difficult to do it successfully. Some people have inside corporations have VC arms and that have worked out well, but there are a lot of tensions that make that difficult. From how do you compensate a team that could otherwise work in an industry that has a 20% or maybe higher in venture capital, sometimes carried interest? How do you compensate that team within a regular way corporation? Also, how do you deal with the fact that the innovative companies that you might want to invest in and partner with may view with some suspicion sharing a whole bunch of information with somebody that has thousands of huge multiples of their resources and could potentially kind of run away with an idea rather than partnering with someone. And then how do you as a little company get the attention of these big corporations? So if your strategy as a small company is to sign up a huge company to a big deal, you might be waiting a long time to get that to happen, and you might not get the attention internally in that company that you want. And so one of the things that we're seeing is, oddly enough, the benefit of intermediation. So often you think of intermediation as just an additional cost. Here I think there's a significant benefit where a private equity sponsor can say, we'll partner with one or more industry leaders in a specific space. We will be very sensitive to what their goals are. And then we will also go and get outside money, not from those industry players. And we will make regular way private equity investments, growth capital investments, venture investments in these emerging companies. And we'll be able to tell the emerging company, you don't have to worry about kind of prematurely sharing information with the corporate,
right.
the corporate strategic, because we're in the middle of that. And by the way, if they like you, they might roll you out to 20,000 stores. And if we like you, we already have a structure. We have a kind of a team integration with the people at the sponsor to execute on these things. So basically, you're telling the investee companies, this corporation has outsourced to us this function, and they recognize the value that we bring to it, and we can very quickly get go, no-go decisions out of them, and a go decision means you ramp up like crazy. And so I think that's going to be interesting to see how that plays out. There are a few early movers in that I think are doing it well, and we'll see how much it catches on. And it won't work in every industry, but I think in a lot of industries, it's a solution to what is otherwise a hard to solve problem.
Yeah, no, it's very interesting. Be interested to see how that develops. And then the final topic we were going to cover was the sort of idea of family offices becoming increasingly sophisticated and institutionalizing themselves. But is this something which you're seeing a lot of? And in terms of what does that mean? Does that mean they want to do more deals directly, or co-investment and fewer funding investments, or are they doing deals between family offices? Give us a sense as to what's going on in that space.
Sure, and I think what we're seeing is a trend that family offices have always been invested in private markets, and often that's how they got to be family offices. Is they had a very successful, maybe a couple generations ago, founded a very successful company. They have also started investing in funds years ago, and then they moved to doing co-investments with some of those sponsors, in part to learn more about how these deals are done, and in part for the return. And then not all of them, but a number of them have developed an internal team that not just does those co-investments, but looks for other investments, whether they're sort of strategic to areas that the company has a specific interest and background in, or just investments more generally. Maybe they'll do some of those investments with other family offices that they're close to, or kind of friends and family, if you will. And in groups where that's been successful, we've seen a number of them decide that they want to take on third-party money. And that's a big undertaking. It's not for everybody.
Yeah.
It often means becoming a regulated entity from previously not being a regulated entity, and all the costs that come with that. But we have seen a number of families do that successfully, and a lot of interest from other families. Not clear that they all want to scale to be $1 billion of outside money, but some of them do, and others want some other mix of things that might require more infrastructure, more tax planning, and maybe more regulation than they've had historically. But once they kind of build out that internal team, there's a real interest in leveraging that investment into a bigger offering.
Yeah, very interesting. Now I realise we're sort of up in time, but I'm going to go back to Steve just to see if there's any questions which have come in during the. So Steve.
Yeah, we're starting to get some questions through now, so thank you very much for that. One question I asked is, what do you think about the trends which we're seeing in impact investing?
I mean, I'm saying that is one of those
Tim,
things.
Maybe you go first on that.
Yeah, I was going to say that, mate. I pick that up all the time when I go into conferences. That from being an area where people were not, where I think it was a little bit more paying lip service to it. I think a lot of LPs now are much more interested in it, partly because their ultimate beneficiaries want a story about this, or want to know what the situation is, whether that be a university endowment where the students want to know, or a pension scheme where the beneficiaries want to know about it. And so it seems to, my observation would be that there's going to be more and more information required from the GPs and the funds in terms of what impact they're having, not just if you're an impact fund, but what impact are you having anyway, across a whole range of ESG characteristics. So my observation would be, like, this is an issue even for all the funds, irrespective of whether they call themselves impact funds. But that would just be one observation. But Chris, what's your take on this?
Yeah, I think we've definitely moved to a place where ESG is a real thing for these sponsors. So it's moved beyond lip service. I think Europe was frankly there early, but I think the whole world is on board for this being an important item. And you were seeing sponsors develop real ESG policies. There's a sponsor that has taken it to a kind of an extreme in their portfolio, trying to make, I think, if I remember correctly, they're trying to make their entire portfolio kind of carbon neutral, which is quite an undertaking. So I think there is a fair amount. There's a lot of ESG kind of weaving its way through the market generally in what is now a real rather than lip service way. There are also funds that are focused on elements of impact investing, like better packaging and things that are environmentally focused, for example, et cetera. In terms of impact investing funds, I think we're very early in that, and that's kind of a tough thing, because at the end of the day, most investors are in private equity for the return, and to the extent you're trading that off for impact, I think that appeals to a smaller piece of the market. I think people recognize that you can do good and do good, or do well and do good, I guess might be the more proper way of articulating it. And so I think it's early. I think there may be more, check this space, there may be more developments here, but for right now, I think it's kind of small, but interesting.
Yeah, and I certainly think the consultants who are very important in this area, who often advise the institutional investors, are getting more and more interested, wanting more and more data, and to have a story. In a sense, it's one of those metrics against which GPs are measured. And I can see there being if GPs don't take it seriously, even if they never have an impact fund, impact in the title of any of their funds, they don't take it seriously. I think it's going to start to become a major issue for them. But Steve,
we've got more questions coming in, so we've got time for a few more. So one of the questions which has come is what type of leverage levels are you generally seeing within portfolio companies and at the wider fund level?
Yeah, so the portfolio company leverage is probably a little outside of this. I mean, if you want to speak to it, feel free, Tim, but I think at the fund level, for private equity, growth equity, kind of non-hedge funds, non-real estate funds, we're seeing the amount of leverage that's permitted drifting up. It's historically been 15 to 20% of commitments. Now, recognize that early in a fund's life, that can be a huge percentage of assets, but 15 to 20% of commitments was where it used to be. I think that's drifting up into 25, 30, in some cases, but still rarely as much as 50% at the fund level in terms of leverage. Steve, I know there's a bunch of questions. A couple of these are probably easy to answer quickly. So just in the interest of kind of answering more rather than fewer questions, what type of preferred returns are recent funds generally targeting? So I'm not sure if it's returns or preferred returns. The preferred return for buyout and growth equity and similar funds, not venture, not necessarily real estate, not necessarily credit, still is kind of stuck at 8%. And people don't really have much interest in changing it. There's no way that for the LPs to really push it higher in today's environment. And it is a tough sell, although you see some people doing it, for GPs to push it lower because it's a disappearing hurdle. And so it's only relevant in a small range of cases. And when you're telling people you're going to make them 18%, 20% on their money, and then you're worried about ending up in the range where this matters, which is basically between 8 and 10%, there's not a lot of sympathy from the LPs for the argument that the preferred return should be lower. It makes you sound very like you lack confidence in your achieving your targeted returns. There was also a question, how do you see PE functioning within Islamic finance? It's difficult to make that work. We are seeing more questions about it, and we've spent more time looking at potential solutions, but it's difficult. And so I think there may be, there are very few examples that I'm aware of that getting done. There may be some more going forward, but that's relatively hard to make that work. And then there was another question that seemed like a relatively quick one, just kind of clarifying on the corporate VCs. Do they actually work? Is there evidence that corporates should be doing this and not independent VCs? I mean, venture capital has, had a bit of a spotty record just more generally in recent years. I think corporate venture capital is hard to make work. I think people use it to mean different things in different corporations. So it may work for the goals that corporation is trying to achieve. But the challenges that I articulated earlier still exist. So it's hard to compensate a great team within a corporation. It is hard to get an emerging company both to sort of trust revealing all their secret sauce to a huge corporation, and then it's also hard for that company to make progress within that corporation without a champion outside of it. So it's difficult, and it's not so I don't know that we can say they should or should not be doing it, but I think the past decades in corporate VCs have been, in my view, lots of talk, some things getting formed, if you will, but not, lots of that getting abandoned or kind of being sidelined and not being as successful as people would like. I mean, Google obviously does tons of investing in things, but if you take them out and look at more regular way corporations that, make physical products or sell more traditional services, I think it's tough to make those work, and I don't think there's lots of examples of that being done in what pure financial investors would say in a successful way.
Yeah. Okay, thank you very much, Chris. We do have a couple more questions, but I think we're pretty much up on time. So I really wanted to thank everybody who has paid attention to today and registered it. Thank you very much for doing that. We will be sending a recording of this conversation to you as well. So if there is any point which you needed to check back into, then you'll get that over the next couple of days. I'm really then to thank Chris Kallos from Kirkland Ellis in New York today, also Chicago, for his time and insights, and Professor Tim Jenkinson. So thank you very much, guys.
Thank you.
Just also a final reminder that we will be running our executive education program in private equity in June, due to start on the 8th of June. As things stand right now today, we are business as usual, planning to run that. Obviously, this is an evolving situation, as we normally have quite a lot of international participants in the group. So watch this space, but we are registering for people as usual. Further updates on that will be in your email. But really just wanted to thank everybody for your time today, and hope to speak to you again soon. Thank you.